Have you thought about becoming financially free through real estate investing, but don't have the time or knowledge to get started? Welcome to the Real Estate Cowboys podcast. Each week, we discuss passive income investment opportunities in the red-hot Texas market. John Larson and the Real Estate Cowboys will show you how to leverage their team to build wealth in real estate through passive investment opportunities. And now, here's John.
Hey everyone, welcome to another edition of the Real Estate Cowboys radio show. This is John Larson, your host. This week we're going to be talking about passive investment strategies. Many times I have investors that come to me and the number one thing that they're looking for is cash flow. John, I need cash flow. I want the highest amount of cash flow. I just do not think that that's the right way to start looking at any investment. If you're looking at what's my highest cash flow, what's my highest cap rate, so on and so forth, there's a lot of other things that go into investing, especially with passive real estate investing. And generally, when you're looking at high rate of return, high cash flow, you're also looking at a higher risk scenario. In today's market, we're definitely in a seller's market. So opportunities for high cash flow in good neighborhoods, opportunities for high cap rates in good neighborhoods with the rising prices and the rising interest rates now, it's going to be very, very hard to find. And so when you're going and looking at any investment opportunity, if you're looking for a turnkey provider, whatever it may be, you're trying to get in your dollars working for you in real estate passively. If you're chasing the highest cap rate and the highest cash flow, you're already setting yourself up for potential disaster. And I'm going to tell you why. We'll talk about that as we go on with the show. But I also want to talk about different passive investment opportunities that are available to you and what is the best passive investment opportunity for you at this stage in your life with the money that you have available to you, whether it be in cash savings or whether it be in a retirement account. How old are you? What is your current age? How soon are you looking to retire? When do you plan on retiring? What do you do for a living? Some people have a lot more going on than others. Me as a business owner, I will tell you that my days are very filled with a lot of different stuff. And the last thing I want to deal with is trouble with my investments. I have a daughter that I try and spend as much time with as possible. I run a business. I have employees. I like to golf. I like to hang out with my friends here if I can. I like to spend time with my wife, my family. I like to go on vacation. The reason I invest in real estate is because I want a passive experience. Now, my job is an active real estate model where I'm going out and acquiring homes and doing the renovations and managing crews and managing the properties for our investors and all the stuff that goes in with running a business and doing the flips and doing all that stuff, which is very, very time consuming. And so I know what the active side of the business looks like. It's stressful. It's a job. I do not want the same type of experience with my rental properties, with my private lending opportunities, with my vacation rentals, and so on and so forth. And so I do ask my investors many times, what's your age? How many years until retirement? What do you do for a living? Tell me about your family. How many kids do you have? I like to hear about their life because I like to tailor an investment strategy to not only what their goals are, but also what they're looking for in terms of how passive do you want this investment to be. I think the word passive gets thrown around way too loosely in this space and in real estate investing in general. Not all markets are the same. Not all property classes are the same. You're not going to have the same experience owning a rental property in one market as you would another market. It's just not. You won't. A market that's not experiencing high population growth and high job growth, you're going to have more vacancy. You buy a C-class property, you're going to run into more trouble just because of the type of tenants that they attract and the type of areas that they're located in. They're just more troublesome. The risk for crime, the risk for break-ins, the risk for evictions, the risk for extended vacancy, the risk for all that just goes way up. Which is why I prefer, and I say very much on this show, to buy very close to or at the median value in whatever market you're looking to invest in. If you're analyzing a market and the median home value is too high to make sense for a rental property, don't go buy a super low price property in that market just because you want a rental in that market. Don't go invest in Phoenix where the median value is over $300K and buy a $100,000 house there because you want to invest in Phoenix. A $100,000 home in Phoenix is not in a good neighborhood. Same goes for Dallas. You want to invest in the Dallas market, the median home value here is $280,000. You want a passive experience, you better invest very close to that $280,000, at least start looking at $200K and above, or you're not going to be in middle class neighborhoods. You're not going to have a passive experience. You want to buy a $100,000 property in Dallas, it is not going to be in a good neighborhood. You are going to run into trouble. It's not going to be passive for you. So the reason I like to ask my investors, what do you do for a living? You're still working. How much time do you have each week to put into your investment? How much time each month do you have to put in your investment? I'm not shocked to hear that most of my investors say not a lot. I have a family. I'm a physician. I'm a doctor. I'm an attorney. I run my own business. I don't have a lot of time, John, to deal with investments, which is why I'm coming to a group like you. You guys find the properties for us. You renovate the properties for us. You manage the properties for us. Well, I can do that model in any market across America, and I can do that model among all property classes. I can go buy properties in very distressed neighborhoods, high crime neighborhoods that on a spreadsheet will show a very high rate of return because it's a $60,000, $50,000, $70,000 house. But are you going to have the best experience? Are you going to have a passive experience? Can I guarantee that property is going to run smoothly, consistently, year over year? No. And so if you're willing to take on the extra risk, if you're willing to have the hour-long conversations with your property manager, if you're willing to sink money into a property year over year, if you're willing to deal with high turnover and extended vacancies, if you're willing to take the risk to leave your property subject to being broken into and vandalized and things stolen from it, if you're okay with that, then go invest in C and D class homes and chase a high cap rate or high rate of return. But I'm telling you right now, you will not have a passive experience, and you'll probably end up kicking yourself that you went down that path and bought that property. Okay? Anybody can sell a lot. Anybody can sell high rate of return, in a fancy spreadsheet. Anybody can sell that. I don't do that. I prefer not to do that. I don't invest in that stuff because I want a passive experience. I run a company. I do active real estate investing. I have a family. I have a child. I don't want to deal with problems with my rental properties. So I don't buy high risk, high reward rental properties. I don't. I buy rental properties in the right markets where you're experiencing high population growth, high job growth, because I know that I can keep those properties leased consistently. And then I buy in middle class neighborhoods because I know that the tenants that I'm going to attract in those properties have good jobs and their families, and they'll probably stay long term because their kids are in a good school district and they're going to take good care of my house while they're living in it. They're paying their bills on time. I'm not going to have to evict them. And if they do move out, I'm not going to sit on a property vacant for 3, 4, 5 months. I'm in a market that's growing by almost 150,000 people a year, so it's very easy to keep the property leased. And once again, we all know these don't work unless there's someone living in there paying rent. Okay? The property does not work unless someone is willing to live in the property and pay you rent every month. To pay for your taxes, to pay for your management fee, to pay for your principal and interest payments, right? And a lot of investors look at the principal payment like it's an expense. It's not. If you're keeping the property leased consistently, why is the principal payment an expense? They're paying down your balance. The only time it becomes a quote-unquote expense is if you can't lease the property and you're paying the principal payment. And we don't want to pay our principal payment on our rental property. That's not why we're investing in rental properties. We're investing in rental properties so the tenant can pay the principal balance down. And if we select the right market where values will hold or continue to go up in price, you're hedging your bets. You have property values increasing while the tenant is paying the principal balance down each month. Okay? The interest is an expense. The interest is also a tax write-off. The property management fee is an expense, but it's worth it because that's where the passive experience comes into play. You don't want to manage the property. You need a property management company, right? And you need to make sure you hire a good property management company. Somebody that runs their property management company based on investor experience. They want their investors to have a good experience. So that means somebody with, low or limited fees. It's a property management company that strives to keep your property occupied year over year. A property management company that strives to get you increases in rent year over year. Okay. Not just set it and forget it. Oh, I don't want to bug the tenant. I don't want to risk losing them, so I'm not going to ask for an increase. No, we want rent increases. And if you invest in the right markets where you can get rent increases, you can get them year over year. If you invest in markets where nobody is moving in, no jobs are moving in, there's nothing going on, it's stagnant. Okay. And it also means that if we go through a rough economic time, which economists are predicting that we could potentially be going through another recession as early as 2020, if you want to invest in the higher risk markets, the ones that are more susceptible to down economic times, okay, then not only can you run the risk of more people leaving that city for other opportunities elsewhere, like Texas, and have higher extended vacancies, but also you're running the risk of buying a property today at the top of market value and then having that property devalue greatly in the next 18 to 24 months. And what happens if life happens? What I always try and tell my investors, what happens today? You're in a good financial position. The economy's doing well. We're not in a recession. You feel safe and secure at your job. You're healthy. Everything's running good. What happens if that changes? You just bought a bunch of properties in a volatile market that's susceptible to a decrease in value in down economic times. You just paid top of market value for this house in Detroit, Cleveland, Memphis, Indianapolis, right? And now we go through a recession, and now that property is worth a third less than what you purchased it for. In some cases, I've seen it as bad as close to 50% in a devaluation. And you need to sell. Well, now you can't. So many investors, when they start investing in property or in any investment, they're excited. They want to buy something. They want to get their money to work for them in the real estate market. They want to avoid paying taxes on money. They want the highest cash flow they can get. They're looking at this get rich quick scenario. Oh, I can put $20,000 down to buy this house, $15,000 down to buy this house, and I'm going to make 20% returns on my money. It's just not actual. It's just not actual. You can do that, and a spreadsheet will tell you you're going to make 20%, but real life will tell you you won't make 20%. Because C and D class properties attract C and D class tenants. C and D class properties are not in neighborhoods where retail homeowners want to buy. Properties in those neighborhoods are traded on cap rate. They're traded from investor to investor. If you need to sell that house one day, you're not going to get a retail home buyer that's going to pay you the top of market value that doesn't care what it rents for. They just want to live there because there's exemplary schools and it's an awesome area to be a homeowner in. No, you're not going to have that. So that's why I don't recommend that. I don't recommend to put my investors in that type of scenario. It's not going to be passive for them. It's going to turn into a money pit at some point. C and D class properties attract C and D class tenants. C and D class properties attract C and D class property management companies. Now, I think I've said on my show before, I've given an example. I have friends in the Detroit area. They run successful C and D rental portfolios. They manage them themselves. They know the tenants. They place the tenants. They knock on the doors when the tenants don't pay. Okay? They train the tenants to not call for every little maintenance issue. Then you can have potentially a good experience, but it's going to be a job. You're not going to do your day job and be a doctor, lawyer, business owner, software engineer, and then go manage a portfolio of 10 C-class properties. So I like to ask exactly age, years till retirement. What do you do for a living? I like to ask about family, like I said. Do you like to vacation? What do you like to do in your life? Why are you investing in real estate? Many times the one go-to is always the cash flow. That's what everybody wants to point to. But you hear me and Keith Weinhold, who's on my show, and if you listen to Get Rich Education, we talk about the 5 to 6 ways that real estate pays you, not just cash flow. To look at just the cash flow is short-sighted. To look at just the cap rate on rental income is short-sighted. Okay? You need to look at the overall spectrum, and you need to look at the fact of, do I want passive investing, passive income, a passive experience, Or do I want to roll the dice for a higher risk, higher reward scenario, but I know I'm going to have to deal with problems? I myself don't want to deal with problems. So when we get back, we're going to talk a little bit more about this. This week on the Real Estate Cowboys, we are talking about passive income investment strategies. We'll be right back.
Did you know there are 6 different ways real estate pays investors? Are you interested in getting started with real estate investing but just don't know how? Investing in real estate can be challenging, especially if you don't have the time, experience, or resources to do so. At American Real Estate Investments, they do all the hard work for you. They're a DFW-based company that buys homes in great neighborhoods, professionally renovates them, and places business professional tenants in your property. With their program, you can start earning headache-free passive income and equity growth from appreciating values in the fast-growing DFW market. There is no better place in America to invest in real estate today. To learn more about how their investors are earning up to 100% returns or greater with their program, give them a call at 888-323-AREI or visit their website at areiusa.com. That's 888-323-AREI or areiusa.com.
Welcome back to the Real Estate Cowboys radio show. This is John Larson. This week we are talking about passive investment strategies. We have no guests this week. This is just me on the show trying to provide some knowledge, experience, things to look out for, things to do, things not to do when looking at a passive income investment strategy. And keyword passive. So we're talking about single family homes first. The reason why I like to ask age, the reason why I like to ask years until retirement is because I want to figure out, does the Fannie Mae finance opportunity, is that work for you? Does that work for you? Me being 32 this year, Fannie Mae finance makes total sense for me. Locking in 30-year fixed interest rates at 5.5% makes total sense to me. I already have rental properties that I purchased in my 20s. On 30-year loans. Those properties are going to be paid off when I'm in my 50s, early 60s. That makes total sense. I no longer have a principal and interest payment attached to these properties at that point. I am now cash flowing fully on these properties. Now we can talk about cash flow. There's no principal and interest payment. I had business professional tenants in my passive properties that I bought in good middle class neighborhoods in strong markets that are growing exponentially due to exponential job growth. Dallas, Houston, Austin, Texas in general, Waco, looking at many other kind of second tier cities in the Texas area, in the Texas market, looking for appreciation, looking for rising values, looking for stable economies. And like I said, looking for consistent population growth, because the properties do not work unless there are people willing to pay you rent to live in them. Okay. So I'm looking at setting myself up for the most passive experience possible, which is why I do not deviate too far below the median value in any market. Analyze the markets, whatever market you're looking in. If it's a rental, you want to be in an affordable market. So even though Dallas, I consider A-class, high population growth, high job growth. If it was $350K was the median value here, it wouldn't make sense to invest. It's $280K. You can buy a $200,000 house in the DFW area that's in a great neighborhood that's going to attract great tenants for years to come and should at least hold value, if not continue to go up in value year over year. Now, I don't go invest in A-class properties in another fast-growing city like Phoenix because the value is too high there. Okay, I don't do it in Austin anymore because the values have run too high there. The values will eventually run too high even in Dallas. Okay, it's going to happen. The window is going to close here. But there's other cities that are coming up, which is why I will not really invest outside of the Texas market. I don't think I need to. Still have property in Detroit that I bought coming out of the recession that I feel I got a deal on. I feel like if I was to buy those same properties today, I'm paying too much for them, which is why I'm not very bullish on any of the cities, the quote-unquote cash flow markets in the U.S. right now. Because look at the pricing. It's right back up to where it was pre-recession. And if we go through another recession here in the next 18 months, 24 months, the prices are going to go down drastically again. It will happen. It has happened historically. It will happen again. Last recession, you didn't see a big price drop in Dallas. You didn't really see any drop. When you look at the economies that we have here in Texas, when you look at Houston and Dallas specifically, look how diverse they are. 23 Fortune 500 companies in Dallas, 24 in Houston, 43 Fortune 1000 companies here in DFW, most corporate headquarters in America here in DFW. That's why almost 150,000 people move here a year for jobs. We go through another downturn in the economy. The Rust Belt suffers. The Midwest suffers. Some of these other areas in the U.S. suffer where values are too high, where there's not enough jobs to support the people that need jobs during a downturn in the economy. Where are they going? Where are they going? They're coming to Texas. That's what they did last time. They'll do it again. So 150,000 people moved here last year. Let's see how many people move here during another recession. This is where the opportunity is. This is why if I'm buying cash producing properties that are dependent on tenants living in them, why do you not want to invest in the areas that are seeing the highest population growth while it's still affordable? And guys, some of my investors who've just never been able to pull the trigger have been thinking about it for the past 3-4 years. And while they've been thinking about it, prices have continued to go up. They've missed out on the appreciation or a chunk of it. While they've been thinking about it, the interest rates have gone up. Now the cash flow looks even less. The cap rates are even more compressed. And it's not just happening in Dallas, people. It's not. This is happening all over the U.S. You're buying in good neighborhoods across the U.S. Values are going up. Cap rates are becoming compressed. You want to chase higher cash flow in today's market, you are buying in a C-class neighborhood, D-class neighborhood. Your risk is going through the roof. Trust me, I've done it. I don't invest in A, high B properties because they're pretty, because, I make more money selling them. I don't do that. That's not the case. Honestly, my holding costs to produce these type of homes, my rehab budgets are much higher than if I was to dance with the devil and do the C and D class properties again. I won't do it. There's too much risk involved. There's nothing worse than renovating a property, getting 80, 90% done, and in the middle of the night, someone goes in and breaks in, steals everything, and you got to redo it again. It's not good for the investor. It's not good for the provider. It's not good for anybody. It's horrible. My management company doesn't want to touch that stuff. Why? Because it's not worth the 8 to 10% per month management fee to manage those type of tenants and those type of properties in those type of neighborhoods. It's not. They're not safe. There's too many problems. You're always chasing down rent. There's evictions. There's issues. It's not worth it. And if you really want a passive experience, once again, do not buy properties too far below whatever the median value is in any market. The median value here in Texas and Dallas right now, and in Texas, I believe it's just over 200K. In Dallas, it's 280K. That's still affordable. The nation's average is floating around there. Okay? But where else I invest in Kansas City, okay, where we produce properties for cash flow, quote unquote, for our investors, the median value there is 190. You can get a $120,000 house in Kansas City and it'll be in a good neighborhood still. 150, you're in a great neighborhood. You buy at 180, 190, you're in an A neighborhood. You're buying right at the median value. Now obviously, as you buy in better neighborhoods that are going to attract better tenants that are going to result in a more passive experience, the values are going to go up, which is going to mean that your principal and interest payment is going to be higher, which is going to lower your cash flow, okay, which is going to lower your cap rate. But your chance to attract good tenants year over year, the desirability of those neighborhoods is higher, so your vacancy should decrease. The opportunity for you to have more long-term tenants is greater because there's families and good schools and they want to keep their children in those schools. And the opportunity to achieve passive returns and a passive experience is far greater in that neighborhood and at that quality of a property and that class of a property, which is why I really try to push my investors into the high B A class inventory, because I know it works. It works for me. It will work for you. It works for many others. It will work for you. It works for many of my clients, which is why they want to come back and buy more. The only thing that disappoints them is that they bought from me 2 or 3 years ago and they were able to get a $150,000 house in Dallas in a good neighborhood. Well, we can't do that anymore. The values have run up. They're looking for the same type of returns in the market that they got 3 years ago. The market's not the same as it was 3 years ago. The interest rates are higher. The values keep increasing. We can't stop the values from increasing in a market like this where there's 150,000 people a year moving. It's just, you can't. The demand is too high. The supply is not there. And so it's predicted that, DFW right now, it's sitting at about 7.1, 7.2 million people. It is predicted that it's going to reach 9 million people within the next decade. That's the market I want to invest in while it's affordable. And let's not forget, the principal pay down, in my opinion, it is not an expense. It only becomes an expense if you can't keep your property leased. But if you can consistently keep your property leased with good tenants, they're paying your principal balance down. And if you're targeting the right market while the principal balance is being paid down, and you're targeting a market where prices are going to continue to increase or at least hold value, you are hedging your bet. And so, like I said, when I'm talking to my clients, what are you really looking for? Sir, ma'am, you told me you're looking for cash flow, but now I just told you and explained to you and educated you on the fact that higher cash flow is going to come with higher risk, higher headaches, more problems. It's going to make you have to become more active in your real estate investment. Then they start to think twice about that. Then I need to remind them that there's 6 ways that real estate pays you, not just cash flow. And then we need to talk about what truly are your goals with this investment. And many times I find out that really the real reason my investors and why people want to invest in real estate is for the tax shelter. So I have years where I make more money than expected. And I'm sure there's other people listening to this show where it's the same thing. I received a bonus. I got a promotion this year. I made a bunch of extra money. What am I going to do with this money? I don't want to pay taxes on it. I don't want to pay taxes. I don't want to pay 25, 30% on this money. So you decide to put it into real estate, where real estate provides you a tax shelter. You stick the money in assets. You get that money working for you. But don't get the money working for you in something that's going to be troublesome, that's going to end up turning into a money pit. How does that help you? Don't chase the high cash flow, high rate of return, because there's a good opportunity you can lose that money. Put it to work for you in an investment that works, that's stable, that's consistent, that's going to attract good tenants, that's going to be passive, that's going to work. And I will promise you, 5 years from now, you will say, John, thank you. Thank you for that advice. I didn't need the cash flow anyway. I'm a doctor. I'm a lawyer. I'm a business owner. I'm making good income. I'm 35. I'm 38. I'm 42. I'm making good money. What's the extra $200 that I could have gotten in Indianapolis with a C-class property a month? What is that extra $200? What is that extra $2,400 a year really going to do for me if it's just coming with 5 times more risk? What is an extra $2,400 a year going to do for you if you're probably just going to end up having to put it back into the property? Let's really think about that. And then you're buying in a market that just, never know. You go through another recession, your property's worth $130 in Indianapolis right now, $100K, $80,000. What is it going to be worth during another recession? History tells us that those property values devalue as great as 50%. And then you have to sell the property. Can you sell it at that point? No. How could you? You just got a mortgage on it for $60,000, $70,000, $80,000. And now the property's only worth $60,000, $70,000, $80,000. You can't sell it. You're stuck with it. So a lot of investors, I feel, they just don't take into consideration exit strategy, which is so important. They're excited to invest. They want to buy something, but they have not considered, what if I had to sell? What if life happens? What if I need to get this money out of this investment? Am I buying in a market, or am I buying in a neighborhood where there's huge demand for property? Am I buying in a market where it's stable and safe, where it's prone? It's I don't want to say prone. It's not susceptible to down economic times where you see large devaluations. The Texas market has proved that it can withstand a down economy. It withstood one of the worst recessions we've ever experienced in U.S. history. And it was resilient in coming back. So I really factor in exit strategy. I think it's a very, very important thing that's very much overlooked. And I feel like I have my money in assets right now, and we're holding assets at our company in the Dallas-Fort Worth market. because we know that this market is resilient. We know that this market is stable. We know this market is secure. And it's just because of the jobs, plain and simple, and the fact that the market's still affordable. But that could change. So the opportunity here is becoming less and less. All right, we're going to take another quick break. When we come back, we're going to talk more about passive investment strategies. I want to talk about private lending when we come back, so stay tuned.
Looking to complete a 1031 tax-deferred exchange and are needing financing for your replacement properties? Let Graham Parham at Highlands Residential Mortgage guide you through the process and make your 1031 exchange go smoothly and on time. As a seasoned investor, Graham owns several investment properties himself, and he can share with you the best way to plan your exchange. Graduate into a better property or properties and make use of leverage to obtain better cash flow and higher returns on investment. Highlands Residential Mortgage has one of the best in-house loan processes to deliver your loan on time and without any surprises. We are 1031 exchange friendly. Call Graham's toll-free direct number today at 855-326-6802 for your free mortgage consultation, or visit us online at texasinvestorloans.com. Highlands is an equal opportunity lender, NMLS 195724, located 1201 North Central Expressway, Dallas, Texas 75234. Highlands Residential Mortgage, NMLS 134871, is not a financial advisor.
And welcome back to the Real Estate Cowboys. John Larson, your host. We are talking this week about passive income investment strategies and where to put your money, depending on age, depending on years until retirement, a lot of different things, depending on the fact, do you have a retirement account? Do you have a healthy retirement account? So now I want to talk a little bit about private lending as well. So we talked about single family homes. We talked about ways to achieve passive income. We talked about ways where single family homes make sense for the investor. You got to think, are you in that age right now where it makes sense for you to take that long-term Fannie Mae debt, right? Are you in a position and at an age where when that 30-year loan is paid off, you're hitting retirement or right around, just a few years into retirement to where you can really maximize the cash flow on your properties? My Texas homes, 5 homes. If you own 5 homes in Texas, because I do A-class properties that rent for a high rate, when they're paid off and there's no principal and interest payment attached to it, they're all cash flowing over $1,000 a month. 5 homes can get you $60,000 or greater in passive income, truly passive income, because they're going to continue to attract good business professional tenants for years to come in this market. People that pay their bills, people that take care of your home, people that are very easy to deal with and easy to manage. Okay. Now let's talk about private lending. Now let's say that you are in your 50s, late 40s, and you have access to 401k money. You have access to an IRA. I highly, highly, highly recommend diversifying, getting that account self-directed and doing private lending and doing it in the markets where there's very low risk. Investing in projects that are very low risk. When I'm thinking about lending money, number one, I want to hear, what's my interest payment? What am I going to get? What's my return? But I also want to know, how am I going to get paid back? Exit strategy, people. How am I going to get paid back? I want to make sure that I'm lending money to a borrower with a proven track record that's trustworthy and honest. And I want to make sure that I'm investing in a project that's a safe project and that's in a good market that I know can withstand down economic times, right? Because with private lending on developments, your main risk is really going to be speed to market, because we know markets shift, markets change. And doing private lending opportunities in markets that don't have high job growth, high population growth, high demand. If you're developing a single family residential neighborhood, if you're developing mixed use commercial buildings, if you're developing retail space, if you're developing industrial space, and you're doing it in a market that does not have high population growth, high demand for that stuff, and you can foresee in the future going to continue to have that demand, you are risking that money. That risk is high. And I'm sure the borrower is probably offering you some very, very high rate of return, high interest payment. Of course they are. They have to. Once again, selling what I call selling the lie. Okay? Or fluffing up something that's really not that attractive, but you're fluffing it up with high rate of return. That's the only way you can get people to invest in money in projects like that or in markets like that. is by offering some unrealistic, super high rate of return. Now, if you're going to do private lending, I definitely recommend, look for the double-digit returns. I mean, you can get 10% or better by being a private lender. And 10% or better monthly dividends that go into your self-directed retirement account, tax-free or tax-deferred. That is an awesome, awesome, awesome investment strategy. But do it with the right people and in the right market. And make sure you have some recourse. So with our private lending opportunities, we do a deed of trust. We develop land, we develop buildings, we flip single-family homes, and we give the borrower or the lender a deed of trust. So if we did default, which I don't feel we will ever default in this market, if we're doing things right, which we have a proven track record, if we're doing things right, we're picking the right projects, we're in the right market to where it's fail-proof. But if we did fail, you have a deed of trust, and you get to go ahead and proceed with the foreclosure process, take ownership of that land and that project, and then sell it and recoup, a portion of your funds or all of your funds. But at least you have that recourse. You have that protection. So private lending, is honestly the most passive model that's out there. You loan $100K, you get 10% on your money for that year. Let's just use simple numbers. You're going to make $10,000 on that $100K over 12 months, $800 a month, whatever it is. Passive. And that's why I don't really recommend to my investors who have retirement funds to buy property within their IRA or 401k. Because we all know rental properties come with expenses. And I don't want people's retirement account to dwindle due to expenses. And I don't want my investors to go buy C and D class properties in risky markets with their rental portfolio. Because you can experience extended vacancies. Where are the expenses? Where's the money for the expenses going to come from? From your retirement. If a roof goes bad and you need $4,000 to $5,000 to replace it, it's coming from the retirement account. I'm all about growing the retirement account passively. And you can do that through private lending. So for those of you that are listening and you have access to retirement funds, look into private lending. Look into self-directing. Here at the Real Estate Cowboys and at American Real Estate Investments, we can help you get self-directed. We can help you start diversifying that money. And Fidelity and those guys are going to hate to see that money go because they're not getting paid on it anymore. They only get paid on that money by keeping it in the traditional investments. They're going to try and talk you out of it. But we have partners that work with you and work with your custodian and work with your financial advisor to get that money moved over. Private lending is an awesome way to earn that fixed rate of return. Real estate, the stock market did great in 2017. This year, not as good. Private lending in the right market with the right team can keep earning you 10% or greater on your money. Monthly dividends, tax-free, tax-deferred into the account, growing that account. So for those of you that are looking for cash flow, right? They don't want the 6 ways that real estate pays you, the tax benefits, right? The appreciation potential, okay? The leverage. If you just want cash flow, do you have an IRA? Do you have a 401k that you can access? Can we self-direct that money? That's a great way to get cash flow. $800 a month cash flow on $100K. And we can just keep rolling that money into future projects. Just keep rolling it. Just keep it working. Just keep that $100K working for you. Just working year over year. And you do it in the right market with the right team, money's going to keep coming. Money's going to keep coming. Risk for default, very limited. But, like I said, you're younger. You're in your 20s, 30s, early 40s. You're still working. You qualify for Fannie Mae finance. Yes, definitely diversify. Take some money. Take advantage of leverage. Buy some single-family homes in the right market. Some single-family homes that are going to get you a passive experience. Right? Because what we want to do, we want to pay the loans off. We want to use the tenant's money to pay the loans off. And then once they're paid off free and clear, we can either sell them, put a big chunk of change in our pocket, or just keep holding them. Pass them on to our kids. Pass them on to our grandkids. Because then they get to reap the benefits of having these awesome properties in the Dallas market, Houston market, other awesome growing markets across America where there's no principal and interest payment attached, own them free and clear, and they're generating $1,000, $1,200 a month. Boom, 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 boom. That's a great idea. But then, hey, you got retirement funds? I don't know. I wouldn't buy any property. Buy property early on in your life. Lock in the 30-year debt. You're 50, you're 55, you don't own any rental properties, you have a retirement account. Let's look at private lending. It might be a little too late for you to get in the real estate game. Okay? Let's look at private lending though. Let's grow that retirement account. So that's a lot. That's why I ask all the questions. I love to talk to my clients, my potential clients. I love to find out about them. I like to find out what is your why. Why do you want passive income? Why do you want to invest in real estate? And I find out a lot of times they either need the tax shield. Everybody starts with cash flow, but through a conversation, I find out tax shelter. I find out money's not doing very well in the stock market. Money's not doing it well in these other investments that I invested in. I've heard real estate's a great opportunity to build wealth passively. It can be passive or it can be very troublesome and very active. Buy the right property, buy in the right market, buy in the right neighborhood. And then for those of you who are retired or on the cusp of retirement, I had a friend of mine that reached out to me actually last night. We knew each other in Michigan. He now lives in South Carolina. He reached out to me for some advice on some vacation rentals, which is another thing that I'm a big proponent of. Because I believe, real estate investing can also give you that return on life. And he asked, John, should I invest in a property in Myrtle Beach or should I invest in a property in Panama City Beach? And just not knowing that much about each area, but vacationing in each area, I immediately said, well, Panama City Beach would probably sound like the better option just because I feel like there's probably more rental demand year round as opposed to Myrtle Beach, which is a little bit more cyclical, I would think, but I don't know. So what I did is I referenced him to AirDNA, which we talked about on last week's episode with David Leroux, and talked about short-term rentals. He heard that episode, and that was what kind of piqued his interest to reach out to me. And so after doing a little bit of research, he found out, yeah, John, you're right. Actually, Panama City Beach, they get higher rents, and it's in higher demand for more months throughout the year. So we also do vacation rentals because for my investors who are on the cusp of retirement or who are retired, they want to live out the rest of their years, enjoy life with their wife, with their spouse, with their families, right? Their friends. And a vacation rental is a great way to give you that lifestyle investment, give you an opportunity to go down, experience paradise when you want to, and when you don't want to use it, you have a full service management team down there. They rent your property out for you on VRBO. And if you're investing in the right market, right, which Belize and southern Belize is a fast growing area. Imagine if you could have bought property in Hawaii in 1950. That's what we have in Belize. An opportunity to get in on a fast growing area, the second fastest growing area in the entire Central American region. And beautiful properties. David Keener, who was on my show, my development partner there. Beautiful, beautiful properties. We just got our other island just finished. You should see these photos. They are beautiful. And a friend of mine is actually getting married on the island in September, so we're really excited about that. But we have a great tour coming up. We do a tour every month where we take investors down to Belize and show them the opportunities that we have. And like I said, if you like to vacation, if you love the Caribbean, if you want to get in on an area outside of the U.S. and diversify some money outside of the U.S. To a country that is very similar to the U.S. in the type of laws that they have, and especially laws with real estate, you get a title when you own one of these properties. It's not like these other areas around the world where you're on a 99-year lease. You own this property. And we've created a fractional model to where we can make it very, very affordable for you to be an owner of a private island, to be a part owner of a resort, to be a part owner of a luxury home for a fraction of the cost. It's much more affordable than you think. And the fractional model makes sense because you're not going to be there all the time. So this is not a timeshare. This is a fractional model. You own a property with partners. You own it. You're not buying time. So this is a great opportunity to look at as well. It just depends on what your goals are, what you want out of your money, what you want out of life. But what we're doing in Belize is an awesome opportunity as well. And so if any of this interests you, if you found any of this information informative, got something out of this show, please subscribe to the podcast, Real Estate Cowboys. Get the update every week. The show airs on Sundays. So you can get the newest episode. And you can also go to realestatecowboysdfw.com. And if any of these investment opportunities sound good to you and you just like to find out more about them or more on how to get started in any of these investment opportunities, how to invest in Dallas, how to buy single family homes, how to get involved in great private lending opportunities. How do I get self-directed? I have retirement funds. I'm not self-directed. My money's in a rat race in the market right now. Or Belize sounds great. I'd love to join you on one of these upcoming tours, which are deeply discounted. Take you and your wife, you and your husband down on one of these awesome tours for a very affordable rate. Just inquire on the Real Estate Cowboys DFW website. And when you inquire, you're also going to get weekly updates on investment opportunities that are available. So we can keep you in the know on all these great opportunities. Single-family rentals for equity, single-family rentals for cash flow, private lending opportunities that get you a strong fixed rate of return, very passive, or vacation properties, which are also professionally managed in beautiful Belize. You can get all this information, more information on this. Just go to realestatecowboysdfw.com, put your information in, tell us what you're interested in. We'll make sure you speak to the right person and you get all the data that you need to make an informed decision. But for those of you that are ready to take action and start getting your return on life and investing in real estate and taking advantage of all the great things that are available to you through real estate investing passively, if you are ready to take that step, go to realestatecowboysdfw.com. My book is coming out soon, the Passive Income Guide. Be on the lookout for that. There's great information in that as well. I will let you all know when that's available. It'll be available for purchase on the Real Estate Cowboys DFW website. And then also, for those of you who aren't sure, you like everything that you've heard, but you aren't sure what type of investor you are, go on our website, realestatecowboysdfw.com, and take our investor quiz. 10 simple questions will tell you what type of investor you are. So for once again, thanks everybody for listening to this week's episode of the Real Estate Cowboys. I hope you found this to be very informative and got something out of this episode, and can't wait to put out another great episode next week. So thanks again for listening. Have a great week.
All opinions expressed by the hosts of the show are the opinions of American Real Estate Investments, LLC, and do not reflect the opinions of guests or sponsors. No personal or professional advice heard on this program should be considered an endorsement to follow a real estate financing or investment strategy. Before acting on any information, seek advice from your financial, tax, mortgage, or real estate advisor, as the information is not guaranteed and investment strategies have the potential for profit or loss.